Hello everyone, welcome to Intel Investors, and in this video we're going to talk about some of the uses or the applications of the Relative Strength Index Indicator, or the RSI. And I have here the Forex Tester 4 application, and what you can see on the screen is the Euro-Dollar daily chart, and I have inserted the RSI indicator right down below. Now we actually have an article for this, so if you kind of want the text version of this video's topic, then you can just go ahead and visit intelinvestors.com and look for the title of this article. Now, the first purpose of the RSI is to identify the strength of a trend. Okay, now the RSI has two standard levels, the 70 and the 30. So these levels, what these levels tell a trader is the oversold and the overbought regions. Now a trader has a decision to make. It's either he's going to buy or sell the asset he's trading. And obviously he has another decision whether to just remain on the sidelines. Okay. But what the RSI indicates is if it's in the oversold region, in the 30, that the likely movement of prices there's a possibility that it will go up in the next few days. And conversely, if it's in the overbought region, the likely direction of the next few candlesticks is likely to go downwards. Okay, so right now, this is a chart from 2010. The Euro-Dollar, the RSI for the Euro-Dollar is in the oversold region. And let's see if the RSI is on point with what it indicates. All right. Okay, so as you can see, the RSI was able to tell the trader, or to tell us, that this downtrend is starting to lose its momentum. And as soon as the RSI points to or indicates that it's at the oversold region, buyers had some momentum to buy at that particular point in time and drive the prices up for at least 4 days before sellers regain their strength back. Now let's look for a bearish example. I think this one would do. See, there's a good strong uptrend happening here, and the RSI is already screaming that it's overbought, and here sellers had the momentum to sell the Euro-Dollar at this point, so driving the prices down, but not strong enough to completely reverse the trend that we're seeing here. Okay, and eventually it did go up even further, but this is just a clear sign the sellers could potentially dethrone the buyers. Okay, so that's the first purpose. The second one is for determining the general direction of price, and for this we have to make use of the 50 level of the RSI. So it's not just the 30 and the 70, we can also use the 50 level. Okay, now the 50 level on the RSI graph tells us where the general direction of prices are. Okay, so if the line on the graph is above the 50 level, that means the general direction is in an uptrend. Okay, but if it's below it, if it's trading below it, like for instance this one, the prevailing trend is going down. Okay, so that's generally what it indicates. Now the third purpose is for signaling a trade. So for signaling a trade, it's kind of the same ideology as the first purpose of using the overbought and the oversold regions as a basis for taking a trade. But RSI isn't typically an indicator that traders use to signal a trade per se. It's used as a supplement to another indicator or some price patterns that traders see on the chart. Okay, but for the purpose of this example, we'll use it as a basis for taking a buy or a sell position. Okay, so the way this works is the RSI must cross, if it's in the oversold region, it must cross above it first, cross below it, and then above it, like what happened in our previous example. Prices were trading on a downward slope. RSI is indicating that it's close to the oversold region, and then once it moved past it or moved above it, that's our buy signal. Okay, and yeah, we did get a few profits after the initial signal, after the initial first day of trading, for until probably 3 days straight, and we've seen from here at this point that our gains were eradicated. Okay, and it even went to as low as this point. So basically we've been stopped out if our stop losses were just below our entry price. Okay, we could have been stopped out at this price over here. Okay, so the same mechanics goes for using the overbought region. So if it's above the 70 level and it crosses below it, that's our signal for a sell trade. Let's look for an example. This one nearly touched it. Oh, there you go. That's a signal for a sell trade, but it didn't work. See, the prices started trading higher. I think this one would be a better example. What's the level here? Let's just enlarge it. Yeah, it happened here, and price just dropped. See, so that's typically how you would use an RSI for signaling a trade, but it's never used as a sole indicator. That's the key takeaway from it. Now the fourth purpose is for supplementing an analysis, and the example that we've shown in our article is this chart. It's the same chart that I'm using now, but this one also makes use of the 50-day moving average. Okay, so it's a supplement to the trend line that we have here and the moving average right over here. Okay, it's at the overbought region, sorry, and it also there's a macro resistance level right here that it failed to break above of, and that's one signal. And the trend line here, that's the potential target, and also the moving average, the 50-day moving average. And it's another way for traders to kind of get some compelling reasons to take a trade. Okay, and the fifth purpose is for spotting a momentum change. So how does that happen? Well, we make use of divergence. So we spot a divergence if the RSI, for example, in the chart here, we see it moving up, okay, but the price is moving down. There's a lower low and the RSI has a higher high. So they are not in synchrony anymore. And usually when this happens, when you see this on a chart, it's a signal for a reversal. And that's exactly what happened right after we see the divergence. Prices started trading upwards. And the last and final purpose of the RSI is for signaling a failure swing, and this was noted by Charles Kirkpatrick and Julie Dahlquist in their technical analysis book. So as we stated, a failure swing happens when RSI crosses above 30 or crosses below 70, reverses, and takes an aim back to the overbought or oversold area, then misses and proceeds to the direction of the correction. Now, this definition may be a little too confusing, so let's just take a look at the example we laid out. Okay, so the euro dollar from this point was on poise to go up. The RSI was signaling that it's already at the oversold region, so this downtrend is in danger of the prices reversing or heading upwards. Okay, that almost happened, but it was stopped from this point after the line on the RSI graph crossed above the 30 level. It was stopped from here, then it made a way back to the 30 level, couldn't quite make it. It's just a hair away from the 30 level, and then it made its way back to its climb. And from that point only, when the euro dollar started trading upwards. So here, the initial signal here wasn't quite ready, but here it was. So that here is the kind of the failure swing. All right, so there you go. That's the 6 uses of RSI that we highlighted in this article. So again, if you want the text version of this video, then just go ahead and go to intelinvestors.com and have a look at it. Again, thank you so much for watching, and make sure you subscribe to our channel.